In this video, we will look at relative valuations, specifically focusing on trading and transaction multiples. To understand this concept, let us use a simple analogy from the real estate market. When you want to buy an apartment, how do you decide if the price is fair? You usually look at the prices of similar apartments in the same locality. You compare the parameters to see if the asset is cheap or expensive. This is exactly how relative valuation works for businesses. It is an intuitive approach where we establish an indicative value for negotiation. There are two main types of comparables we use in this process. First, we have trading multiples. The source for this data is stock market peers and it reflects the daily trading sentiment. Second, we have transaction multiples. These come from recent merger and acquisition transactions. Transaction multiples are often considered to have higher authenticity because they reflect the actual price a buyer was willing to pay to acquire a company. While relative valuation provides a quick estimate with limited calculations, it has a downside. It reflects the current mood of the market, which can be overly optimistic or pessimistic. Therefore, a good strategy is to always use parameters like the maximum, minimum, and average to account for these mood swings. Now that we understand how to value a company by comparing it to others, let us explore how to handle companies that are actually a collection of many different businesses. Next, we will look at sum of the parts or SOTP valuation. This is also known as the cluster approach. Large corporations like ITC or L&T often operate as a bundle of distinct businesses under one umbrella. To value them correctly, we cannot look at the whole bundle at once. We must unbundle the cluster. Imagine a conglomerate has three different verticals: vertical A, vertical B, and vertical C. The best method is to value each vertical independently based on its own earnings and assets. Once we have the individual values, the math is simple. The formula is the value of vertical A plus the value of vertical B plus the value of vertical C equals the total SOTP value. This summation gives us the total business value, allowing us to see the true worth of each part of the company. While these traditional methods work for established industries, we need a different set of tools when we look at the modern digital economy. Moving on, we will explore other valuation parameters in new age economy and businesses. When we look at the valuations for tech, e-commerce, and social media companies like Zomato or WhatsApp, traditional mathematics often struggles to justify the high transaction values. In this new age economy, we use a different vocabulary. We look at metrics such as eyeballs, footfall, page views, and the number of users. We also calculate ARPU, which stands for average revenue per user. However, we must apply what we call the Buffett Reality Check. The golden rule here is that all these alternative metrics must eventually translate into profits for owners. There is a significant risk involved. Without visibility of future profits, these valuations rely entirely on storylines and the belief that a next buyer will exist. The consequence of this is severe. Without a believable story, valuations can fall like a pack of cards, just like we saw during the dot-com boom of 2000 to 2001. With all these different methods and metrics available, it leads us to a very important question about the nature of our work. Finally, we will look at the objectivity of valuations. When you see a valuation report, the extensive computations and maths suggest that it is very objective. However, the reality is that valuation is a highly subjective exercise. You might wonder why. There are two main reasons. First is input bias. There is a lack of generally accepted standards for the inputs we use. Second is time sensitivity. Valuations can change dramatically as business circumstances change. So if you ask the core question, is valuation objective? The answer is no. Complicated quantitative models do not mean the valuation is precise. They often only create a false impression of preciseness. We must remember that there is no single precise estimate of value.